Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings. Today we're diving into a report from Carvana, and believe me, it's not your average new car smell kind of story, more like a used car with a mysterious history kind of deal. Let's see what's under the hood. Alright, so this is a Form 8K filing from Carvana. This is basically a quick update a company sends to the Securities and Exchange Commission, the SEC, whenever something important happens that investors should know about. This one is dated February 19th, 2025. The main reason for this report is to announce an update to their at-the-market offering program, which they call the ATM program. Basically, this is a way for Carvana to sell shares of its stock over time, like slowly releasing them into the market instead of all at once. Carvana is doing this through an agreement with some big financial firms like Barclays and Citigroup. They'll be helping Carvana sell these shares. Think of it like Carvana hiring a sales team to quietly sell off some of its stock over time. Scroll ATM shares will be made from time to time pursuant to a shelf registration statement. Scroll. These shares are being offered under something called a shelf registration statement. This basically means that Carvana already got permission from the SEC to sell these shares at some point in the future. They're just now deciding to actually do it. There's also mention of a legal opinion about the validity of selling these shares. Kirkland and Ellis LLP, a law firm, gave their stamp of approval saying that Carvana is allowed to issue and sell these shares. It's like getting a mechanic to say your car is safe to drive before you try to sell it. So what does all this mean? Carvana is basically raising money by selling more of its stock. This can be good because it gives the company more cash, but it also means that existing shareholders own a smaller piece of the pie. It's a bit like cutting a pizza into more slices. Everyone gets less. Now for my take on all of this, Carvana is in an interesting spot. The used car market can be tough, and they have faced some financial challenges, and the company is seemingly trying to sell more shares to shore up their financial position. One of Carvana's strengths is its brand recognition and innovative approach to selling cars online. They made it easier to buy and sell cars without having to step foot in a dealership. But they are also their challenges. One major risk is their debt. They have a lot of debt, and paying it back will take a big chunk of their earnings. Also, the used car market is sensitive to economic ups and downs. If the economy slows down, people might put off buying cars, which would hurt Carvana's sales. Looking at the stock price, it's tough to give a precise valuation without diving deeper into their financials. But based on their current situation and the overall market, a reasonable price range might be between $25 and $40. This is based on a mix of their sales growth potential and the risks they face. I'd lean slightly bearish as they still need to prove their long-term profitability. So to sum it up, Carvana is taking steps to strengthen its financial position by selling more stock. While they have a strong brand and innovative business model, they also face risks related to debt and the economy. It's a bit of a mixed bag, but their ability to manage their debt and adapt to market conditions will be key to their future success. Thanks for watching. If you found this breakdown helpful, please subscribe to Corporate Decoder for more plain English explanations of corporate filings.